So let's split out the two marketplaces into defined benefit and defined contribution. I think really what you're describing really applies mostly to the defined benefit market, but could it also apply to the defined contribution marketplace? I know that there are other consulting firms and advisors that are managing mutual funds, that are creating collective investment trusts and separately managed accounts that kind of do this type of work. But where are you seeing long-term the trend? Is the trend in DB, or is it in DC, or is it in both?
So I would say currently it's more on the defined benefit side. In terms of the trends, I think the trends are more on the defined contribution side. As you said, the collective trusts, in particular the target date funds. The target date funds are truly the vehicle where you see a lot more of the innovation as it relates to the types of strategies that are appropriate. So whether it be alternatives, where you'll see hedge fund type strategies, you'll see tidbits of real estate and property, you'll see tidbits of private equity. You'll see overlay hedging solutions. Within those targeted strategies is where you see innovation and packaging in a way that's acceptable to the participant. We're still in the early stages. I think some of the larger corporate 401k plans who are managing those target date funds internally, you'll see some pretty interesting things.
You and I have talked over the years about the importance of educating plan participants in a defined contribution plan. So I think we would agree that the foundational elements of a DC plan are design and also investments. And kind of once you set it, it kind of runs itself. Now it's about how do you use the plan effectively, how do you communicate. When you introduce this level of complexity, because it is a more complex type of environment, and how do you explain this? You've got to spend an inordinate amount of time explaining how this portfolio is constructed, and that's really a big part of how you work with a plan sponsor on the DC plan.
So you have the benefit of a lot of the diversification benefits that defined benefit plans have enjoyed all these years, as continuing today. I guess it's only right from an investment perspective that the defined contribution participant, through their target date allocations or their traditional balanced allocations, have the right to have that diversification just like a DB plan. In terms of education, I think that things like real estate, things like private equity, things like hedge funds are a little more tangible than they were 10 years ago. I think real estate is very tangible to everyone. I think private equity and buying, selling companies is very tangible. And I think the concept of the hedge fund, with a lot of the regulations continue to increase in that area, I think the comfort level is getting better.
And what we're seeing in the custom target date marketplace and the target date marketplace in general is that what's important is what are people actually doing in the program? Are they rolling money out at age 65? Are they leaving money in for a longer period of time post-retirement? Are they, and really that drives a lot of the decision making. And also, what are the goals and objectives of the DC program? I mean, we're here today talking about public funds here at the Public Funds Forum. They have defined benefit plans, so the DC plan is a supplemental program generally for governmental workers. So I really think that really has to be baked into the design and development of a target date fund strategy, as you're suggesting.
No, we're in total agreement, and as I'm sure you've experienced, the look and feel of the DB plan and some of those characteristics are being implemented within the DC structure in terms of best practices, and we're fully for that.
And I think fees, 2012, the fee disclosure rules, certainly they apply to ERISA plans. Fees are important, and so that level of transparency, so if you include a hedge fund of funds, something, or you create a custom target date fund portfolio, not only communicating what is in the portfolio and how to use it, but also what is the makeup, the portfolio makeup, and also the fee makeup is probably going to be equally as important to meet those fiduciary requirements.
And I think it's the job of those, I'll call more alternative type strategies, from a reporting and transparency standpoint, that if they want to play in this realm, that they have to play by these rules. And I think there was probably a general sense, I would say 10, 15 years ago, hedge fund didn't want to be transparent. The private equity firm didn't want to divulge compensation. And real estate managers are more for the institutions and ultra high net worth. So, but as we discussed, as much as we want to talk about trends and what's going on today, defined contributions is a trend that I think all asset managers across all asset classes, it's not a choice, whether they want to play. If they want to be around 20 years from now, it's a place they have to play. Oh, 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 it's a place they have to play.